Recording. We are here.
All right, we are here. It is episode not one, not two, episode what's this? 3 of Real Time Real Estate. Today we're going to be. I'm actually really excited about today's episode. We're gonna get real saucy with you guys. So like, really stay tuned. Hang on to your horses. I am Jahleel Special, your mortgage loan officer.
It's about that time. My name is Darius D. Coleman, D-Time Estate, LLC. I'm your local real estate agent here in Washington.
All right. So yeah, we serve the Washington State area and areas abroad. We serve the country, really. So even if you're in Atlanta or Florida or wherever, we can service your needs. So just give us a call with your questions, put your stuff in the chat, of course, because we're doing this for you. We're making this content so that we can educate you. So we want to hear your voice, and if you have questions, please let us know, and then that's how we're going to create more content for you. All right, so how about we get into this? I'm gonna set this up by telling you guys that this banking world is pretty cutthroat these days, which means a lot of competition, because you guys as the customers, it is definitely within your rights to shop around. And of course, once you found that loan officer that's going to be able to work with you, service your needs, and of course you stick with that person, and then you work with them. Now, sometimes for me, from my perspective, once we get someone under contract, now we got to put together creative solutions, because I know I'm not the only mortgage bank in existence. There's a lot of them. And that's where this strategy came into play. How about I just go ahead and share my screen so we can get into it. All right. So in 3.
Yeah, Jahleel, before you jump into your scenario, I wanted to ask a couple questions for you, just to kind of get an update on what you've been doing in, the past couple months, past couple weeks since our last episode. We talked about the Home Ready Conventional. It was new onto the market. It was a new program. And we kind of want to know what your thoughts about it. Do you still like it? Are you still offering it to your clients? Is it something that you offer first, or is it a kind of a case-by-case basis? What are your thoughts on the Home Ready Conventional? What is a Home Ready Conventional, and what are your thoughts on it?
Hey, you got it. All right. So, yeah, it's Home Ready. I am definitely offering that product like legit every day of the week. And it's one of the products I will offer first, actually. So, and I do try to, when I'm taking in a loan application, it's really like a blank slate, because ultimately what my job is to take the information of the customer and then match them with the loan program that's going to work best for them. And this is one of the loan programs that I look to qualify customers for first, because I believe it creates the most like short and long-term benefits. And that's why I look to it first. And then if we can't go with this route, then I'll usually look at different options. So with the Home Ready Mortgage Conventional, thank you for reminding me about this, because more people need to know about it. Everyone knows about FHA 3.5% down. You hear it on like almost every YouTube channel, podcast, Instagram reel. Oh, you want to buy a house? 3.5% down. Like, that's how you do it. And the gurus are talking about 3.5% down, not knowing about this conventional 3% down loan option. So obviously, one, it's a whole 0.5% less required for down payment. Number two, it's conventional. It's a conventional loan. What does that mean? Well, when you're in the market buying a house, oftentimes the seller is going to look at that offer. And actually, I have to ask you, D-Time, when you're like representing the seller and you have multiple different buyers coming with multiple different loan programs, is there a difference between like conventional offer or FHA offer or a VA or a USD offer? Like, do you see any difference in any of those like loan programs when you have different buyers coming to talk to your seller about buying their home?
Oh, that's an interesting question. To be honest with you, it's not totally different from FHA to conventional per se. Obviously, the numbers, like you said, 3.5%, 10%, 20%, depending on what they're putting down and what they're able to put down. But the only time it gets really tricky on my side is when it's a VA loan.
Oh, okay.
And only because there's different rules. They have different requirements
Right.
It's still pretty simple. Obviously, I'm just, from what I do, because I don't have to really deal with the financial side. You have to
Right.
deal with that
That's
part.
true. Yeah. Yeah.
But there is a couple of rules in certain things that a VA loan compared to a conventional and an FHA loan. Just a little bit different, just because there's certain rules a VA has to go, because obviously they have the zero down program to where they don't have to put nothing down, right?
Right.
To where
Right.
now there has to be a little bit more paperwork, a little bit more, you know, dot your I's, cross your T's, because they got to make
Absolutely.
sure it's all approval and all that good stuff. And then
Right.
it's really strict on the appraisal side, to where
That's
they got to
true.
make sure that loan fully covers that purchase. So it's just a little bit different there, but that's a great question. But yeah, no, it's FHA and conventional. It's almost the same once you get, before, for me it's the same, just because I'm dealing with it the same way. I'm writing the offer the same way. We're going in the process the same way. I think it
Yeah.
just is when it gets to you, that's when it changes. It just changes the number, changes the pricing, changes how they're going to go about. So it changes a little bit, but that's just the game plan that we got to go with.
You got it. You got it. And so, and I'm asking more specific, like on the listing agent side. So like if you've got a seller looking at different offers, like a VA offer versus a conventional, have you seen the seller not really care what kind of loan program?
Okay, on the listing side, not necessarily. So I've had a few. Just had a listing up last month, and not really, because the main objective for the seller is a clean offer. So if a VA, conventional, or FHA comes in with a clean offer,
Yeah.
then that's kind of the most important thing. And then obviously the seller wants to net the most profit, right? So they look at the price point, they look at if it's a clean offer, there's no contingencies on it, stuff like that. So not necessarily.
Okay,
Um,
word.
Maybe, I mean, you might get the occasional military pro family that is looking for a military family, or is kind of more enticed to the military family to help them. But typically, no. They go for the, net the most profit, clean offers, and what offer best is going to help them move to the next part of their life.
Clean. Perfect. No, that's really good to know. Really good because I mean, again, guys, I'm working mostly with buyers. So I'm not usually seeing like the seller side of things and what they're looking at and what's their thought process is, you know what I'm saying? So it's always good for me to be able to ask Darius, hey, what are you seeing on the listing agent side of things? I have, in my experience, I've seen some people be a little snobby for whatever reason when it comes to like FHA loans versus conventional loans when receiving offers. Sometimes like, especially during like 2020, 2021, like things were really popping off and sellers had their pick of the litter. And maybe it was just because of that, I mean, rates were so low, they had so many buyers on the table and so much demand for their house that they could get picky on every little thing they wanted to. And I was starting to see that conventional offers were starting to get accepted more than like government offers. And when I say government, I'm talking about the umbrella. So FHA is a government loan, the VA is a government loan. And it was actually starting to become beneficial. Even if someone could qualify for an FHA loan, we would go home ready 3% down conventional loan, just because for whatever reason, the seller liked that it was a conventional offer over a government FHA offer.
And that makes sense too, because we also do look at what the buyer and lender, how fast they can close as well. So obviously, if there's a whole bunch of stipulations on the FHA, they need this, they need that, they need this, then it's like, okay, let's go conventional, because this one's going to be clean cut. They're putting more down, they're putting 10% down.
Yeah.
So stuff like that, to where we know they're more serious a little bit, even though a FHA buyer is serious as well.
Absolutely.
They're just starting their program. They're just starting with their first time home buyers. So yeah, that's a great question, because I actually haven't looked at it that way, but because for me, I'm looking at a straight offer. Is it clean? Is net profit? Because obviously for me, I'm trying to give the best scenario for my client.
Absolutely.
On the other side. So that's definitely interesting. That's an interesting question for sure.
Word. And honestly, I mean, that just shows that's evidence that you're a real one and you're looking at the right things, right? Is this going to be in the best interest of my seller? Or is this loan going to close? Can I get them the most profit, the most bang for their buck? That's all really a good agent should be caring about. It shouldn't, like, the whole bias on the loan program really shouldn't be a factor, but ultimately, you know, sometimes.
Yeah, sometimes it is. You're absolutely right. It's definitely a great question to ask, especially on your side, to see kind of how you should go about approaching, you know, especially when with the market shifting. Yeah, it's definitely a great question.
Absolutely. Because I just, again, our job, especially from my end, I'm doing buyers or I'm refinancing my former buyers, right? So I want to make sure they're positioned the best to look the best to whatever sellers are wanting. Anyways, guys, the home ready conventional loan, I think that's the one that people should be talking about because it's 3% down, minimum down payment requirement, 620 minimum credit score. So it's pretty forgiving. It's not going to go as low as FHA, but it's pretty forgiving. I mean, you know, you can do a loan at 620, 3% down. Like it really opens up the floodgates. And here's the other biggest thing and reason like I like to go 3% down conventional over an FHA first is because when you get to that 20% equity position, meaning that you own 20% of your home, that's usually going to happen by doing two things: making monthly payments on time and letting your real estate appreciate. All right. So, you know, you have everything to do with making your payments on time, and the market is going to take care of your value. And over time within real estate, values are always going up. Why? Well, because they're not creating more property. All right. You're not making any land. So your real estate's always going to go up in value in time. And so once you hit that 20% mark, that's when you're able to drop off the private mortgage insurance, which is what we're going to talk more about today. With an FHA loan, that PMI is stuck with you for the life of the mortgage. Like, doesn't go away. And that's not money that's going to your pocket. You're not building equity. You're not doing anything. That's simply private mortgage insurance. Is if you put less than 20% down, you are paying to protect the bank in case you foreclose on your property.
Got you. Wow. Thank you. Thank you. Yeah, let's get into this new scenario, man. I'm interested to see what you got going. You kind of, before we started this whole episode, you told me you had a good one. So I'm excited, man.
Oh, yeah. Okay. All right. All right. So let me just pop that thing over there. Share the screen right here. Click, click. Boom. All right. Okay. So this literally happened just this week. And it was pretty gnarly. So had these clients, was working with them for like literally 2 years. And they went under contract, and then unfortunately we're like, hey, you know, we want to start shopping around. And I'm like, come on, guys, I thought like I'm the best thing since sliced bread here. You're not going to shop good old Jahleel Special. But you know what? It happens. All right, it happens. Right. That's the business. So that's what. So had to get a little creative, but I'm grateful for them doing this because I got to learn more things as I did research to figure out a way to be competitive and get them the most bang for their buck. And it happened in a way that I really did not expect. So let's take a look at this and just check in D-Time. Can you see my screen here?
Yep, I can see it.
Okay, bet. All right, so here's what I gotta answer that call that's coming into me. Okay, did that disturb our video?
Nope.
No? Okay, all right. Thank you, audience. This is one take, by the way. So we like to keep it real in this real talk. So this is real. This is
real talk, real estate.
All right. So this was a $520,000 purchase, 5% down conventional. Okay. And so you would think that, oh, the lower interest rate is going to automatically correlate to the lower monthly payment. And that is literally not the case. So take a look at this. All right. So 520 is our purchase price. They're offering a 4 1/8 on the interest rate. All right. And what I ended up doing was offering 5 1/8, but I'll explain my reasoning as to why that is. All right. Now, their monthly payment after this, getting this 4 1/8 on the 5% down conventional 520 purchase price was going to be $3,094. All right. And I was able to get their monthly payment a little bit less to $3,088.27. And I was able to get the cash to close less than $52,000, while the competitor lender's cash to close was just shy over $52,000. So the big question is, how the hell did that happen? Okay, so we're going to click this little more info and I'm going to break it down to you. So there's this little thing we were talking about earlier called private mortgage insurance, right? So if you put less than 20% down, you're going to pay private mortgage insurance. And what we were able to do in order to get this monthly payment to go lower. Oh, also, by the way, the competitor lender, they offered him such a low rate, but it was not free. they were paying $18,000 to get that low rate. Let me just pause there. 18 grand if they wanted to get that low rate. Okay. So it was not free, and it was right there in the loan estimate. And that's how much they had to pay if they wanted to get that low rate. And I'm like, you know what? I think their money could be better spent in a differently. And so what I did was, and I'll just go into the fee detail, or no, fee detail over here on this one. So instead of having that monthly, that private mortgage insurance, by the way, because they're still paying private mortgage insurance on this side, even though they have the lower rate, they're still paying private mortgage insurance. You're actually able to pay your private mortgage insurance upfront as one single time fee. And that really made all the difference. So for them, and then how much is that one upfront mortgage insurance fee if you want to pay it in cash versus paying it as a over the life of the loan as a monthly payment? Well, that's going to depend on your credit score, the loan terms, all that stuff. For them, the cost was $8,694. So instead of adding that to the loan, we simply added that to their closing cost. All right. And geez, okay, I got to tell this guy not available. We added that to their closing cost, and we were able to take away the mortgage insurance. All right. And so as you can see here, when we look at the payment breakdown, we see that they have no mortgage insurance on this scenario, the scenario I presented, versus having $360 a month in mortgage insurance on the other scenario, which is where we're able to reduce the monthly payment up front. So really, really cool. What are some of your thoughts on that, D-Time?
That's amazing. That is a cool. I mean, well, hold on. Let me give you one of those, man. Congratulations on winning your customer back. You know, they wanted to shop around. You said, okay, do your thing, but I got something for you. And you came back with a great offer, a great way to help the client, you know, to where they weren't taking all this money out the bank to, you know, like you said, pay 18,000, and that didn't go toward, that was just the cost to the lender, right? That's not even to
just the cost for the rate. That wasn't everything else, like appraisal,
wow, yeah. See, so my thoughts on that is amazing. So right when you said that, a question popped up. Can you do this with any type of loan, or is it just when it's conventional, or is it certain circumstances, or can I do that with the FHA, where I could pay it up front, or is FHA it has to go with the lifetime of the loan?
Great question. We can do that with FHA, and
Wow.
we can do that with conventional. Absolutely. Now, VA, USDA, those are two different. And I'll talk more about VA. VA has their own form of mortgage insurance called a funding fee. Right. And the only way you get out of paying that funding fee is if you have a disability benefit. So if you have any VA disability benefit, even 5%, 10% disabled, whatever, you get to waive that funding fee. But for conventional or FHA deals, if you've got some cash to spend, so like you've got the down payment dialed in and you have a little bit of extra cash and you want to work that monthly payment down, like ultimately, if we typically only use this strategy if two things happen. You have some money, all right, and you really want that monthly payment to be as low as possible. And you're planning on staying in this property for at least the next 5 to 7 years. All right. Because other than that, you're paying for this mortgage insurance up front all at one time. So it needs to be worth your investment. So if you're going to hold on to this property, turn into a rental, even if you're not going to live in it as a primary, but you're going to turn into a rental and it's going to be a part of your life for a long time, then it's worth it to do that. If you're going to fix and flip this property, you're going to be in this property, you see yourself selling it in the next 3 to 4 years or so. I'm like, even the buying down the points to reduce the rate, to reduce the monthly payment, paying your mortgage insurance up front so you can reduce the monthly payment. If you're not going to be in this property for more than 3 to 4 years, you don't need to spend anything extra towards your closing cost to get your monthly payment down, because you're going to sell it anyway and you're not going to recoup that cost. So this strategy is for this clients. Literally, they had money and they really wanted a lower monthly payment, so that's why I was able to offer it.
Wow, And is this called a certain thing, or is this a play in the playbook that you're able to use?
Yeah, maybe we just call this the Jahleel Vester Mortgage Insurance Special.
I like it. I like it. Man, I appreciate the scenario, man. Again, congratulations on winning your client back and getting them the best deal. But yeah, let's move on to the market update.
Absolutely. And I got a question for you as you're getting ready for this
Okay.
market update. I'm hearing from a lot of buyers like monthly payments are really hard, and that's like it's like they're shocked and they're kind of scared to even take the next step in considering buying a house just because monthly payments are out of hand. Like, do you have anything for that, or anything to answer to something like that?
Yeah, to be honest with you, so you're absolutely right. So obviously with the market shifting, with us going into recession, even though the government won't call it one right now, but we are in recession. Yeah, just a lot's been going on, right? We were in COVID, now we're out, the interest rates went up, inflation's going up, buyers are scared, they don't want supply, like you said, inventory's still the same, basically. So yeah, so the one thing that comes to mind that I've seen a lot lately is the 2-to-1 buy down. And obviously you can probably explain that a little bit better, but the 2-to-1 buy down is where sellers are willing to buy down the buyer's interest rate to help the buyer to have an extra low monthly payment for 2 years. So there's a whole system, it's a whole program. Obviously, it's called the 2-to-1 buy down. Ask your lender about it. It's actually a great system. So, and the reason why I say it's something that's been kind of coming out now recently, just recently, is because one, obviously on the buyer side, it helps the buyer, obviously.
Right.
But then with this market shifting, a lot of sellers or a lot of listing agents are using this to promote their listing to help the buyer, because obviously buyers, like you said, interest rates have been gone up to the roof. Well, not to the roof. They're actually pretty normal, but from compared to where we were, they've gone on super high, super fast within the last 6 months, right? So it's been discouraging a lot of buyers, with that monthly cost, like just like how you had to help your buyer, bring that back down. So obviously they can go to your way. Like obviously I'll mention that now because that's great to where if they got money in the bank, if they're going to stay in there long term, that there's a play, the the Jahleel Special. I'll call it, and I really will call it that too.
Hey, okay, fire.
I'll call it the Jahleel Special. But the other way is a 2-to-1 buy down, to where it's not essentially gonna lower your payment for the lifetime of your loan, but it is gonna for the first 2 years, it brings it down, and then the next 1 year or 2 years, I think it brings it comes back up a little bit, then it'll come back. It's like stages, right? So where you'll have a low monthly payment for 2 years, and then the next 2 years you'll have a half low, percentage will go up, then it'll finally go up to like your last 2 years, it'll finally go up to the original price. To the normal price. So it's cool program. I haven't technically used it just yet, but it's definitely something I've been seeing on listings, and it's something that I've talked to you as a lender and a couple other lenders that I've talked to, and they said this is one of the plays that that's hot right now. But yeah, the great question. But yeah, let's move on to the market update. I'm going to share my screen here with you guys. Can you guys see that?
Yes.
All right, perfect. So you guys can see so this is King County, and that's all. Obviously, we work with King County out here in Seattle, Washington. So yeah, let's get started. So homes for sale right now is 7,930. That's a small percentage increase. So it's looking like there's from last, and this this is for the last 30 days. So obviously, we did this last episode was 2 weeks ago, 14 days ago, and it's increased from there, right? So we got a couple more there. Then you got new to market, 3,750 homes. That was a decrease in the last 30 days. Off market, 49,273, decrease again. Days on market, 57 days. So this is a 6.2 increase. So as you can see, a lot of houses are staying on the market longer. And this is where, that question, what are sellers doing to try to promote and get their house sold? And that's where that 2-to-1 buy down comes into play. They're using this. They're using different systems, different marketing promotions to help the buyer, to encourage buyers to come back into the market and to start buying again. And then we're going to go down to average home price in the last 30 days. Again, this is for King County, $1,217,538. Little increase there, almost 1%. But then obviously me and Jahleel's favorite part, the price reduction.
Come on,
so there goes 2,049 homes that did a price reduction in the last 30 days. This is at a 123.4% increase. And to kind of give you guys, the full picture, as you saw, we have the new to market 3,750, and then you have the price reduction homes 2,049. Obviously, you can see those numbers are very close, probably 1,700 apart, which gives you a 2-to-1 ratio. It's a little less than 2, but it's a 2-to-1 ratio. So that means every 2 homes that go on the market, 1 house is reducing their price.
Wow.
So buyers' prices are getting reduced to where they are definitely market value homes. There's no more 50,000 over asking. There's no 100K over asking. It is, you are getting the list price that you see it at, or maybe even a little bit under. So definitely buyers, that should encourage you to at least look. I understand the the interest rates are high, but then you got your man Jahleel that can play with the numbers and get that playbook to work for you. But moving on, average sold price in King County is $1,029,463. Again, another small increase, and we're gonna move down. So that's the King County update. I always like to just see what's popular on the listing. So you have a couple here in Fall Cities. Auburn, there was a house for 1.6 million, but then this beautiful home to my left, obviously maybe to your right, I'm not exactly sure how you guys see it, but this beautiful home in Hunts Point, $85 million home.
Russell Wilson.
It's on the listing. So obviously this is why these numbers are so in flux, is because obviously there's houses like this on the market right now, still open. So if you got the money, come on over. Let's buy it if you got it. Because I don't got it. But anyways, but also what I like to do is compare Pierce County and Snohomish County just on the average price, so you can kind of see. So the average home price in Pierce County is $661,916. Had a decrease from the last 30 days. But as you can see, the numbers kind of different from Pierce County to King County. And then obviously the average sold price is, again, $612,372. And then moving to Snohomish, you have average home price at $851,545, a decrease from in the last 30 days. Average sold price $771,497, and again another a small decrease from the last 30 days. So these are just the decrease is just basically, to me, in my eyes, is just telling me that a lot of these homes are staying on the market. They're doing a lot of price reductions are going on. Obviously, from the last week, our last episode, it was I think it might have been a 3-to-1, and then the week before that, it might have been a 4-to-1. So obviously, that's trending down as well, getting close tighter and tighter, to where pretty soon it's going to be a 1-to-1, and probably even more. It's probably not going to be able to keep up. So we'll see. We'll keep an eye on that. We'll obviously make sure we get that information to you. But yeah, so that's that for the market update. If you guys have any more questions, that was just a brief market update. If you guys have any more questions, feel free to hit me up, DM us for any questions you have. Hit us in the comments. This episode will be on YouTube. We'll be on our Instagrams. The snippets will be on our Instagram pages. So feel free to hit us up, and we'll kind of make sure we answer those questions for you.
Hey, absolutely. And I just got to say again, like, the price reduction stat is literally my favorite, and just hypes me up every time, because it's like power is shifting back into buyers' hands slowly but surely. And that is just such a wonderful thing, because our market needs that. No one party should have all of the leverage. Like, we need to be somewhere in the middle for everyone to really feel like they've got that win-win. And these last 2 years, as great as they've been in a lot of ways, haven't been the best as far as like having a healthy market where both parties can do a little bit of a give and take. It's just been kind of really give for the buyers. And so now we're in a market where sellers are going to work with you and buyers are going to work to make it happen, and everyone can really just have that win-win. So feels good.
Yeah, that's good. Yeah, appreciate you guys. So look, we're gonna wrap it up here. We got things to do. We got clients to help. So feel free to hit us up if you guys are interested. And against summit funding with your guy Jahleel Special, and then it's about that time with D-Time Estate, D-Time Coleman. If you guys have any questions, hit us up. And welcome to the Real Talk Real Estate.
Peace.
How's it going?